Alright everybody, today let's talk about deal analysis. And imagine you open Zillow or any other consumer's app and then you see a property there and then you think that's an awesome deal. But you're kind of wondering, should I buy it or maybe that's a huge mistake? I'm gonna show you what actually kills deals. And it doesn't matter how good you are, maybe at property management, maybe finding those deals or maybe running other numbers like expenses and so on. If you don't know actually how to put the numbers right, so anything else you'll just be faking it. So in today's video we are gonna cover 5 essentials that you must know before you go ahead and buy an investment property. The first one is the income reality. So this is actually what the investment is gonna bring in every single month. The second one is the true cost. So this is the cost of carrying it on, right? To holding this investment property, you will have some of the expenses associated with that investment. The third one is the cash flow. So this is what that property is gonna get you and you are gonna keep. And the fourth one is cash and cash returns. So this is exactly what your money actually earns. And the fifth one is the long-term wealth drivers. So this is what is building your wealth over time. This actually brings us to the essential number 1, which is the income reality. So this is what the property is gonna bring you every single month. And imagine this is the engine. So if this doesn't work, if the rental income is not coming in, you are not moving forward. It's not even stuck, but it's gonna draw you back. And what is most important here on those numbers to be very, very realistic and conservative. Not what the neighbor rented for and not what the property, this one or the other ones were renting like a year prior or 2 years ago. So you need exactly to estimate what that property realistically is gonna rent out today based on the location, features, and conditions of that property. And if you get this number wrong from the beginning, anything else further and is gonna be wrong as well. There are actually a few ways that you can estimate that rental income that you will have every single month. So you can estimate it by yourself, just do your due diligence. You can open Zillow or any other rental apps and just pick a few properties in the area, same location, same features, bedrooms, bathrooms, and size of the home. And then you pick like 3 to 5 comparables. Make sure those comparables are realistic and it's not something that it's staying on the market for like 40 days, because then it's going to be a different approach to those properties because the market probably is different at that point. But if you have those homes sitting on the market for 7 to 10 days and maybe they will just rent it out, also probably Zillow is going to show you if they have applications. That's going to help you to make a better decision as well, right? And then you just pick those 5 or whatever 10 properties that you're going to run the numbers on and then see what's the range is gonna rent for. So if let's say it's $3,000 but those properties will stay longer in the market 40 days, so maybe you just factor in maybe a little bit of the discount that you'll need to push that property first to go first. Or if not, if just the market is very realistic and it will have like 7 to 10 days and then you have a range from like 2,800 to let's say 3,200, so maybe you just pick like 3,000, and to be conservative you just probably take off like $50 or $100 and then run numbers from there. But let's say you're very confident you can run numbers for $3,000. So that's basically is going to be your initial point where to start from. There are also other ways that you can estimate the rents. You can talk to your agent. They can run through the MLS. That would be another way. Also, you can use some of the websites or apps as for example, Rentometer, Bigger Pockets, and so on. So that's going to be another way. You can use property management companies, especially if you are thinking of outsourcing the management later on. So you can just call those companies and tell them exactly what kind of property, the area where you are planning to buy, either if it's a single family, duplex, triplex, fourplex, multifamily. So they will tell you exactly what you can realistically get for that property as a rental income every single month. Also, as an income, you may have not only the rent coming in every single month, you may have extra income sources from that investment property. That could be maybe you have like laundry machine that is bringing you extra cash for it. Maybe you have extra fees like pet fees or cleaning fees. So that's considered an income as well, even though later you have expenses based on that. But anyway, so you just bring all the income, you just count everything together depending on the type of the property that you have. Now that we know what is coming in, we have to be brutal honest what is going out. So this is exactly where beginners get smoked. and they don't estimate some of the expenses that actually kills deals. This brings us to the essential number 2, estimating the true cost. So this is actually estimating the monthly expenses, because this phase, this essential actually is going to dictate if you can carry on this investment or not. Most of the beginners think if the monthly income covers the mortgage, that's an awesome deal. It may be, but usually it's not the case, because there are like many other variables involved, and there are like probably more than 10 expenses that you have to factor in of carrying on that investment. So what I like to do to categorize in 3 categories those expenses, those are like fixed or relatively fixed expenses. The second is variable expenses, and then third is miscellaneous expenses that you have. Let's talk about what's included in the fixed cost. In the fixed cost usually goes the mortgage. In the mortgage usually it's included PT, which is principal and interest, which goes to the bank, and then taxes and insurance, usually it's paid in the mortgage payment as well. The first 2, those are fixed for sure. If you are buying a property, let's say an investment property for 30 years, fixed loan, so basically you have the principal and interest which will stay the same. It doesn't move, it just goes more towards the principal and less towards the interest. Taxes and insurance, those could be fixed costs, which I usually allocate them at the fixed cost, because those will not increase that much or will not adjust that much, but those actually can fall in the category of variable expenses as well, especially the insurance. For the last couple of years, that fluctuated a lot. Let's say taxes, right? So when we talk about taxes, it depends on the jurisdiction that you are in. Those could be adjusted when the property is purchased, and let's say if the property was purchased 15 years ago, and then you have, I don't know, $5,000 for the property tax for the year, and then it was not purchased for the last 15 years. Now when you buy it, it can be adjusted like $10,000. Instead of having like $300 cash flow monthly, you may have negative, and usually, you know, like that adjustment may eat up the whole profit. So you have to keep that in mind. Or maybe if you are in another jurisdiction that the property tax is going to be adjusted, the county assessor will come and will adjust the value of the property every single year, or maybe once in 2 years. That actually becomes more as a variable, but just because it does not increase that much or it does not fluctuate that much, usually I keep it in the fixed cost. Insurance as well, you can estimate talking to an insurance agent in your area. They'll tell you like a good range for that kind of homes, you know, like in that area. You can use that number, or if you already went through the pre-approval with the lender, so usually they will tell you, just because they have already those estimates, they'll tell you, you know, like in the mortgage payment, what's the actual amount that you'll have to carry on. So that's why usually I keep them in the fixed cost. Let's talk about variable costs. Variable costs will include a lot more small expenses, but those usually fluctuates more, and it also depends a lot on how that investment is operated. For instance, those are like cleaning, repairs and maintenance, capital expenditures, vacancy, management fees, and so on. Also, I will associate here, if that investment property has an HOA, you can just put in different categories. So if you want, you can associate it to the fixed cost or variable cost. Usually HOA, that will adjust maybe in a couple of years, in a few years. So that's usually I keep it in the variable cost. But at the same time, if the HOA covers some of the bigger repairs, let's say for the condominiums, maybe they cover roof, maybe they cover siding, maybe they cover windows, so then I have to factor in less for the capital expenditures, because the HOA actually covers that part. So that's why I keep the HOA in the variable expenses as well. And now we get to the third category, which is miscellaneous expenses. In this category, so it depends on the property that you are buying. So you may have to pay some utilities, maybe some legal fees if you are setting up like an LLC or something like that, or maybe other fees associated with that property. And these are fees that you are paying them anyway, even though it's not something like more predictable. So anyway, you have these miscellaneous fees that you have to factor in whenever you run the numbers. Now let's talk about what's a good range of those expenses to factor in. So let's say if we have capital expenditures, it's very dependable on what kind of property you're buying. If it's newer, maybe new construction, and you still have warranty from the builder, maybe you factor in less, right? If it's like an older property and then you have to replace roof, then you have to replace HVAC, water heater, maybe windows, refrigerator, and so on. So at that point, basically, you'll have to factor in more. But just like a rule of thumb, I'll just probably factor in like 5 to 10%. And then if you factor in like 5 to 10% to most of them, let's say repairs, where we'll include cleaning as well after the tenant moves out, moves in, in. For vacancy, probably like at least 5% as well. For the management fee, if you are not managing yourself, it's another 8 to 12%. And those estimates I just gave you, so those are like the rule of thumb, but you can actually go deeper and analyze and estimate them more precise, and then you know much better when and what to expect. And I'll just tell you like a simple example. Let's say a roof. If the roof is like 10-year-old, so maybe in 10 years you have to replace the roof. If in today's market you need to pay like $15,000 to replace that roof, so probably you have to factor in maybe like $1,200 every single year in 10 years to be replaced, right? So that's just approximate number that you have to factor in. Maybe we'll break it down in another video, like how to do reserve study for the property, but that's gonna be much deeper, and that's not the point to overwhelm you in this video. You might not estimate the management fees like right away because you are managing by yourself, but let's say at some point you will need to outsource to the management company and them to manage the property, right? So you will see like how that cash flow, like positive cash flow, will become a liability when you have to pay that management company. That's why it's good, even if you manage by yourself, it's good to run the numbers from the beginning, including the management fee as well. And now let's run some numbers. These are just the numbers for the sake of this video. It's not something like based on any of the properties. Let's say rent is $3,000, right? And then we have mortgage payment, which will include principal, interest, taxes, and insurance, like $2,450. And then we have vacancy, another $150. Maybe we have repairs, another $150. Let's say capital expenditure, not too old of a property, is another $150 per month. So all these numbers per month. And then we have maybe like 8% or let's say 10% of the management fee, which is like, let's say $250 per month for the management fee. So all in together, our expenses to carry on that investment monthly is $3,150. So basically this investment property in our scenario is gonna bleed you like $150 every single month. Is this a good or bad investment? Just the rule of thumb, probably it's not a good investment, but it actually depends what kind of market you are in, what was your initial investment, and so on. Because what we estimated here, like $150, your negative cash flow, so basically you have to put out of pocket $150 just to carry on that investment, but not always the case, because if we look straight at the cash flow or cash on cash return, so that's a negative cash return, right? Because if you invest, let's say $1 million and you have like even positive $150, that's not a very good return on your money, right? But if you have invested like very little money, maybe like $10,000, you still have negative $150, but maybe you offset, you know, like some taxes, or maybe you have high appreciation and something like that. So that's a different story. The essential number 3. So this is the cash flow. This is exactly what you're gonna keep every single month, and this number has to be positive on conservative numbers and also with no fantasy assumptions. Let's get back to our previous example that we had with $3,000 incoming cash flow, and then we had the expenses $3,150, but let's say that we find a way to reduce those expenses, and maybe we manage by ourselves, or maybe we rent to a tenant that will stay longer in the property, and then you lower the vacancy, or maybe you get like a better deal. So let's say perhaps you negotiate the numbers, negotiate the price, find a better deal, and maybe you have, you know, like mortgage, it's lower, and instead of having $3,150, so you have $2,700. So basically we take the $3,000 and deduct $2,700, which is expenses, like all in expenses for the month, and then we have left for $300. So those $300, this is the net cash flow that you get to keep from having that investment. You know, like investors who are aiming for at least $100 or maybe $200, having $300 it's better and gives you a little bit more protection or a buffer zone. Let's say you counted everything correctly, you know, like the income, all the expenses, everything, but maybe something unexpected happened, and then you have that buffer zone, so you can still use your cash flow to offset some of the unexpected expenses, right? This gives you a little bit more protection, like a buffer buffer zone in case anything happens. And speaking about $300, this is actually your money. You can basically, the money that you have in the return of the investment that you had in that property. So you can take this money and, like just spend it for your needs, for whatever you think of. But later on, I'll tell you the best way of using this money. And speaking about the cash flow, let's take it this way. If we only look at the cash flow, like actual money that we make based on the investment we had, in that situation, we may discard like a lot of good deals, because on the end of the day, it's not only the cash flow that makes this investment profitable over the years, right? So the cash flow will keep the engine running, so it will keep the lights on, so to say, but actually it's not the cash flow that will make you wealthy over time. And in some situations, we may even have like lower cash flow, but we will bet more on the appreciation building equity in those homes. Is it always the case? Maybe not. So there are like pros and cons regarding that, and we can discuss that later. And since we are at the cash flow part of this video, what you can do with the cash flow. Some people, some investors, they all just buy an investment property and they all just say, hey, I need one investment property to pay more for my car, maybe, right? And they all just take those $300, and it depends if your car payment is $600, so maybe you need two of these investment properties, and then you just use that cash flow to pay for your lifestyle. Since we already know what every single month is gonna hit our bank, so now it's time to compare as the real pros do. They would compare deals based on the cash on cash return, not the only metric to go after, but it's one of the important ones as well. That brings us to the essential number 4, which is cash on cash return. This is you actually estimate if that deal worth your money and how hard your money is gonna work for you. The cash flow alone hides how efficient or inefficient is that investment. And you can compare this way. Basically, instead of putting in this investment property, so you may put, let's say, in a stock account or some funds, right? And then you can compare, or maybe like a savings account. So basically, you just see what you can do with those money and how well they are performing on your behalf. How we actually calculate the cash on cash return. It's not that complicated. So technically we need to know how much money we invested in that deal, and then we will divide the total cash flow that we had over the year to total investment that we had. And that total investment that we had could be, like down payment, and then plus we have closing costs unless you negotiated with the seller otherwise, and then you may have due diligence costs that you need to learn about, that home, maybe an inspection or anything like that before you buy it. And then after you buy it, you may have some repairs, some cleaning that you need actually to do before you put in service. And then we basically divide the total cash flow to the total investment, so that's gonna give us the exact return that we have on that investment, on the money that we invested in that property. And in our scenario, so we had $3,600 as a per cash flow. We will divide by $60,000 that we have down payment. Let's assume it's 10%, and then closing costs, due diligence, and maybe repairs or anything related to expenses put in service was another $10,000. So basically we have $60,000 into that deal. That will give us like about 6% return on our invested money in that deal. And when we ask ourselves what's a good return on the investment, it all depends. And I always say you have to have a number in mind, because you may use the same money, instead of putting in real estate, you can use with another investment vehicle. You can put them in stock, in crypto, and so on, right? It all depends on the deal and what's the exit plan of that, and what's actually the plan of that investment. What you're trying to do, is that a flip, is that a long-term investment, or so on, right? So let's say if you have like cash on cash return 6%, so you won't compare like straightforward to like what's the rate is gonna give you if you put in stock, because in real estate you have other wealth drivers that will bring the return up over time, so you don't really have in the stock. So that's why usually if you put in a stock account, so you will want to aim for a higher rate, just because you will need to increase the velocity of money and the return to compound quicker, because usually you don't have other wealth drivers in the stock market compared to the real estate market. Cash on cash is good to have it, but I consider this is a short game, and the real money are made like over time, over 5, 10, 20 years. This brings us to the essential number 5, the long-term wealth drivers. where the most of the money is made, and this is actually what makes you wealthy. When most beginners, they focus on month one, year one, pros think in 10-year chunks. The first one is cash flow. And you may say, hold on, you just said the cash flow is a short-term game. Yes, if you are just spending those money or you use those money for your lifestyle, right? But at the same time, you may use those money to put them back into investment, so that creates compounding investment over time. So that's why cash flow is one of the drivers that will build your wealth over time. The second driver is principal pay down. Imagine that you have that investment, you place a tenant in, and the tenant is paying every single month your principal down, right? So, and every single month it pays more and more and more and more until in 30 years it goes to zero. The third one is appreciation. This shows us how the property goes up in value over time. Let's assume we are modest on the numbers and no crazy speculation on this part. The fourth one is the rent growth. Like every year you can increase the rent for those tenants, and when the income grows up, let's assume the expenses are controlled and stay the same or almost the same. That improves cash flow, and that actually improves return on that investment. The fifth one is tax benefits. Usually it includes depreciation and write-offs, and as I like to say, make sure there is no tax advantages left on the table. Full disclaimer, I'm not a CPA. Make sure you consult a professional on that part. There is also a sixth one, which is a bonus but not necessary to be a driver. Maybe it's just a tool which is more associated to the principal pay down. So that's the leverage that you have with the bank. Imagine that you have 10% put in a deal and the bank has 90% put in a deal, right? But you have to benefit of all the appreciation and upsides on that investment, and they carry the most of the risk. Now let's run a quick summary of what we have talked in this video and how this video actually is going to help you to build your long-term wealth. So we talked about income reality. So what this property actually is going to bring you as an income, and then true cost, what is gonna take to carry on that investment, right? And then what's gonna be your cash flow. This is actually what you keep, the cash on cash return. So this is what your money is earning. The last one is long-term wealth drivers, where the money is made and actually builds your wealth. Make sure you watch the full video where I go more into details on those 5 wealth building drivers. And as I already said in another video, one well-chosen investment can change the trajectory for the whole life. If this video was helpful, make sure you like and subscribe, and also you can comment below any questions you have. This is the channel where I'll put all my procedures that you can use as a guide to buy your first one, maybe the 5th property, and scale from there. Thanks everyone for watching. I'll see you in the next one. Take care.